Hi, this is Terry Porter with the Porter Group here at Keller Williams, and so today we're going to talk about acronyms within our industry and specifically within the loan industry. So listen to a few of these. You've probably heard them before. LTV, DTI, DPA, PMI. What does all that mean? Well, this industry is a little bit confusing at times. There are multiple acronyms that we use in all parts of our industries, loan industry not the exception. I'm going to be honest with you, it's crazy. We've got an acronym that has an acronym or two in it. And if you don't believe me, look up TRID, T-R-I-D. It's crazy. So anyway, it can be overwhelming, and I have a cheat sheet today to talk to you about this to try and keep pace in a conversation with a loan professional, just because you may not have exposure to all of these acronyms and know what they are, and it kind of creates a log jam in your brain when you're in a conversation and you hear those and you don't kind of have a sense of what they're talking about. So let's start where most loans start, okay? How much can you afford to purchase? That's a function of your monthly income versus your current debt, which is an acronym that they use, DTI, debt to income. Makes sense, right? So that's your debt to income ratio, and loan officers are looking at that on a monthly basis. They work backwards to determine a maximum purchase price for your financial situation, okay? So after that, you'll want to determine how much of the purchase that you're going to want to finance, or how much money you're going to put into the purchase as a down payment. So this is expressed as loan to value, LTV. After subtracting the down payment percentage, then the rest of the price of the home is the LTV, or loan to value. So if you plan to put 10% down, say, then you're going to have a 90% loan to value. Make sense? Okay, so putting more money down can lower the loan to value, which can improve your DTI, debt to income, and possibly eliminate PMI, private mortgage insurance. How do you like that? So a few other terms that you'll hear early on referring to the acronyms are loan types. These are different type of loans. The main ones are conventional, then FHA and VA. The VA loans are guaranteed by the government under the U.S. Department of Veteran Affairs. Some veterans are eligible for this VA benefit as a result of their service. So if you're curious about your ability to qualify for this, it's best to speak to a loan officer, a loan professional about that. And thank you for your service regardless. The VA loan can be as high as 100% LTV, which means zero money down, okay? Another government-backed loan is the FHA loan, which is backed by the U.S. Federal Housing Administration. These loans start at 96.5% LTV, which means you're putting a 3.5% down payment down. And these will carry mortgage insurance premium, MIP, for the life of the loan, okay? So that is different than a conventional loan. We'll talk about that in a minute. You may also hear of a USDA loan because it's 100% LTV mortgage. People hear zero down payment and they get excited, and I totally understand that. But these USDA mortgages are backed by the U.S. Department of Agriculture and are reserved for areas designated as rural. The interesting thing about that is some of our more densely populated areas actually qualify for this USDA loan, so that might be something that you want to talk to your loan professional about. One of the final acronyms is DPA, or down payment assistance. Certain areas or borrowers are eligible for down payment assistance programs, and these programs are to encourage home ownership within the area. One example would be THDA, which is a Tennessee-specific down payment assistance program. So as you're deciding between loan products, it's important to remember your goals for the purchase, and a good loan officer can help you with that, can kind of match your goals with the structure of a loan, okay? So for example, a conventional loan, we talked about this earlier on the MIP on the FHA that goes for the life of the loan. On a conventional loan with a greater than 80% LTV will likely carry PMI, which is private mortgage insurance. This monthly premium can be dropped once your loan drops below 80% LTV. Must be dropped once you reach 78%. So on the other hand, an FHA loan carries the mortgage insurance premium for the life of the loan. Then on a conventional loan, if you finance it for 80% or less, then you don't have that monthly insurance. So something to consider. It's complex. to say the least. And that's why you need to work with a trusted lending partner in this, who's looking out for your goals, your challenges, your situation, your plans. It's something that can be catered to you, okay, because there are a lot of different programs that are available. So now that you've heard these terms, been introduced to them, I'm confident that you'll be more prepared to talk with a mortgage loan officer about your financing options. So let us know what other confusing topics or processes that you'd like us to cover in the future. Thank you. Have a great day. Bye-bye.